at the euro dollar. This is a 1 minute chart. I know some of you are freaking out like, I don't want to look at a 1 minute chart. It's going to teach you how to read the tape. It's going to teach you how to read price. It's going to help you understand what I'm doing intraday. And even if I'm showing you a chart with a 15-minute time frame or a 5-minute chart, I am, without you knowing it, I'm looking at 1 minute chart order flow. And this is what I'm looking for. Okay. And as a reminder, folks, this is not Enigma. Okay. It's just me teaching you price delivery. That's it. Okay. So the market's trading up into that buy side imbalance, sell side inefficiency, consequent encroachment that was formed on the FOMC rally earlier in the week. When the market hits that, that's a premium array. That's what we anticipate as institutional resistance. It's occurring during the London open kill zone. Now, and the market trades right up into it, trades into the buy side imbalance, sell side inefficiency, consequent encroachment, some random level, some highly specific level that I've been teaching you for years now. We have the high here, the low, and that higher high as it hits the buy side imbalance, sell side inefficiency, consequent encroachment. Once it hits that, then and only then we watch to see if we break down. We break that low right there. That becomes a breaker. Nonetheless, take that time and go through the charts and look for failed break and retest. Okay, that would be something like this. Forget this buy side imbalance, sell side inefficiency, consequent encroachment. Forget that levels being there. If you're just looking for naked price action and you're looking for all these higher lows and then finally a low gets broken and it comes back up, look for instances where that fails. And you're going to be surprised how often that fails if you're looking for it. But if you go in with the logic that I teach you, like this level here, that is real resistance. So it invites the context to unfold and then a narrative to develop. And what does that mean? As we hit this level, it should break down. It should. So where's it going to break down first? Where's the low prior to that run up? Right there. And here's the high prior to it hitting that. So any buy stops that were above here, for anyone that was selling short early on, they get broken. That's the breaker. They get broken. Then price breaks through that low. When that happens, then we have the breaker, because this level is key, not because we broke this low. Then price has a change in the state of delivery. What does that mean? It was offering buy side. Now it's keyed up with looking for sell side delivery. It's wanting to go lower. When it trades there and hits the breaker, then I'm looking for, okay, right now the narrative is underway that it's going to reach for sell side liquidity. My mind goes into seek and destroy. Where are the sell stops? So right away, you have this low, which essentially was equally traded to, if not went below. I can't tell. Mine aren't as good as they were when I was 20. But we'll just say not that one yet. We're going to look for this one. There's sell side liquidity below that, below that, below that, here and here, and ultimately the low that was formed before the FOMC run up, which is here. Okay, this area right there, when we were trading at 119.35, that's that 119.35. So this chart here on the 15-minute time frame is exactly at that moment right there. These two wicks in here, that's these two highs right there. So I'm looking at this buy side imbalance, sell side inefficiency, midpoint, extended in time, bam, hitting it right there. This is what it looks like on a 1 minute chart right there. And this is the breaker that's broken to the downside, comes back up. There's where you start looking for the change in the state of delivery for price. It's going to start offering lower price. It's not, listen, it's not selling pressure. It's not sellers driving the market lower. That's not what's going on. There's a change in the state of delivery where now the algorithm is going to start offering price lower and lower and lower and lower. And that's why people eventually get squeezed out of their positions. It's not, oh, we're going to keep sending price up because the buyers and we're going to squeeze them out of their trades. That's not what's going on, folks. That's not what is going on at all. Watch what happens when we change the narrative here. We're going to zoom in a little bit. These are the same levels here, but now watch. We have the original consolidation here. I already keyed up on what you're anticipating to see now. This is the market maker sell model. Trades up into the level I teach you. Hits it, breaker here. Now The change in the state of delivery from bullish now bearish right there. As soon as that happens, now the algorithm has changed its gears, if you will. It trades back up and resets to now sell side delivery. That's what it's going to target. Where's the algorithm going to look for those price points, those specific discount PD arrays to start reaching towards? It ain't going to go straight line towards it. It's going to just gradually keep going lower, back and forth, but it's going to go to where these lows are. Well, that's these lows that are highlighted here. But I'm not looking at the low for simple support resistance ideas. I'm looking at the very specific down close candles in those lows, because that's where smart money was buying. From this high here to the left, that's the buy side of the curve of this market maker sell model. Everything from this high to the right is the sell side of the curve. Everything that was buying, like this down close candle here, before this run up, that's your breaker. They could be buying here with a run to that level, and that would be a scalp. That's enough. It's over for them. They're out. When the market breaks down below that low, that's where your breaker is, and then you can mitigate that. How about over here? These down close candles, they were buying in here. That's not causing this run up. They're buying in anticipation of the algorithm delivering a run higher, offering them profitability. That's what smart money traders are doing. Smart money traders are not buying and their buying pressure sends price higher. That's not what goes on. That is absolutely not what goes on. Period. Is where they bought. Over here, in this range, I want to see something that is a premium array. What is that? Bearish order block, bearish fair value gap, a bearish breaker. Look what we got here. We have buy side liquidity being ran out, and we have a fair value gap. Hits the breaker, trades down. Comes to the top of that series of down close candles here, comes out of it, bumps the bottom of that up close candle right there. There's your bearish order block right inside of that range over here. I would look at that and sell short right in there. And many of you will be like, why are you entering there? And if you go on my YouTube channel and see me executing on a 1 minute chart, you'll see entries like that. And it's going lower. Then what happens? We go into another area of down closed candles where they were buying right before this big run up. Notice I said that? They were buying before this run up. They didn't buy it up. They didn't cause it to go up. They bought it and waited. Then the delivery happens. Extend that range of down closed candles over here to the left of this candle here. So we're in the sell side of the curve. Look inside that shaded area. So you look inside here for a premium array. Up close candles, fair value gaps, breakers. There isn't any kind of breaker in there, but we have an up close candle here and the fair value gap. Market trades up into it, closes the gap, hits the order block, and then sells off. It's also optimal trade entry. Then delivery lower. We're inside the original consolidation. So now anything in here, I didn't want to extend this over because it would have been confusing with all the shaded areas, but you can see that we have institutional order flow entry drill here inside the range that's shaded. So there's a sell there. Institutional order flow entry drill there, and it sells off. Sell side imbalance, buy side inefficiency. Institutional order flow entry drill, hold low, which is mitigation, and sells off and attacks the original consolidation sell side liquidity. How many trades is in there? Several, isn't it? Let's go one step further. If you just look at this area in here where the fair value gap is, and this fair value gap there, that could be your model. That's your trades. Isn't that really in ideal locations? With the premise I'm teaching you here. The change in the state of delivery after it hits a premium array, it's not a bullet. It's a breaker. Okay, and once it takes this low out, the logic changes right here, and now the delivery will start being down. But if you sold short in this fair value gap, or sold short in this fair value gap inside of the shaded areas, now this is between the shaded area, and that's fine because we have the fair value gap here and this imbalance. So this bumping the bottom end of this breaker here and the fair value gap is what I'm looking at, not just trading it into the fair value gap. It's, look at the bodies. It's bumping into that breaker and rebalancing that fair value gap that was left open just above this high. These two locations are your redistribution. That's why they're red. I want you to think about it like that. Where these are accumulation in blue. Smart money reversal. Low risk sell. Redistribution. Redistribution. Another level of redistribution, and attacking the original consolidation sell side liquidity. Now, we're going to take a step out from this and look at it on a 3-minute chart. Here's that original consolidation. Here's where those fair value gaps were on the 1-minute chart. See that? Looks slightly different. Maybe not have noticed it so much in here. You have bearish order block here and sells off. And you don't see the institutional order flow entry drill here on the 3-minute chart, but on the 1-minute chart, it's there. So what's happening is when sometimes you watch me on a chart and it's going up like this and you see me selling short right in there, I'm using that 1-minute chart like I just showed you before dropping into the 3-minute chart here. From here or here, targeting that low or that low or that low is a trade for me. Either one of them. Targeting that, first profit, scaling out. Second, scaling. Third, and then leave such a small little portion on, it's insignificant if it stops me out. That's how I look at it. Here's a 10-minute chart. Same fair value gaps. The breaker, which you can't see the breaker anymore. Not in the way that you would expect, but you can see it here. So when you look at price like this, on a higher time frame, like this is 10 minutes, you can see this is a breaker. So you know, okay, let me go into the 1-minute chart, a 5-minute chart, and slice this up into smaller time frames and see if I can get the details here. And that detail is that fair value gap there, but it does trade up into the breaker that would otherwise not be noticeable here, unless you understand the logic behind it all. This fair value gap doesn't even make any sense looking at it from a 10-minute chart, does it? Nope. Now, high frequency trading algorithms are throwing orders in right here. They're throwing orders in right there. They're throwing orders in right there, and then attacking here and taking out here and taking out here. You're selling short when everybody else thinks it's going higher. They're not thinking selling short up here. When retail sees this, it's going to keep going up, only to where it needs to go. Consequent encroachment to buy side imbalance, sell side inefficiency. It's also a higher time frame, daily optimal trade entry. Remember on the daily chart, that's what that is right there. It's at a premium array, at a time of day when it creates what? The higher low of the day. What did it do from the midnight time frame? It went up. All of this is a Judas swing. They're fluffing it up. Okay, the algorithm is saying, look how good this is. This is so good. You should be willing to pay a higher price than it's reasonable. Retail would love that, and they buy it up all the time. There. Then you wait. Now, you may not have the courage to go right in here and sell that as it hits it. I just taught you how to wait. You wait for the breaker to form. When the change of state of delivery happens and it goes back to the breaker, then that's the reset. The algorithm changes, now starts targeting sell side. And you know how to find sell side. It's easy. But retail traders aren't up here thinking, let's start looking for the lows to be taken out. They're not thinking that. They're not thinking that at all. They're either buying it up here or watching it drop saying, man, I wish I would have sold it up there. And you've done that too. Just like I did in the 90s too. Because you don't know these things. But now you're learning. Every swing low, that's sell side liquidity. Old lows, sell side liquidity. Why is it useful? Why is it important? Why do I even label it sell side? Because the context is, if we're up here and we're going down, smart money has sold short. How do you get out of a short? You have to buy it back. That means somebody's got to be willing to sell it to you at a cheaper price. Well, you got to look below the old lows because that's where the sell stops are. They have no choice but to sell to you when it trades there. That's why the algorithm goes there. And that's why they go there quickly. Because they don't want the traders to have their minds changed about, maybe I shouldn't have that stop there and let me get out of that trade. Ah, now it's starting to make sense.